Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This will be the third in a series of videos on high-profile and very popular stocks that I'll be conducting. Today's video will take a look at Alphabet, aka Google, and for the sake of this recording, I'll be calling them Google from here on. One of the things that I pointed out in the written portion of this presentation is the idea that you can't value a business based on just one metric or one fundamental. And that's why I designed FastGraphs to look at numerous fundamental metrics to help me analyze a company. I call it the tool to think with. And when I'm looking to value a business, there's a lot of things that I have to take into consideration. So I'm going to start out by looking at history, although the primary focus of this series of videos is on forecasting. But let's start by taking a look at Alphabet's history. And this obviously is a growth stock. And I'm going to take a couple of things off the graph. This is a plotting of adjusted operating earnings. I'm also going to take a look at GAAP earnings because in the case of Alphabet, with very little debt on the balance sheet, this company has had a very excellent record of producing GAAP earnings. Now I'm going to put monthly closing stock prices on the graph, and I want you to notice a couple of things. That it was trading at relatively high valuations for the first couple of years of its existence, PE ratios in the 50 and 60 range. The PE line, the orange valuation reference line on here, is a PE of 40.7, which it relates to the company's growth rate. But here's what's really important about utilizing a metric like this, and the reason I designed this tool to be dynamic. As I start cutting years off of the graph, I want you to notice that the growth rate is changing dramatically. And I'm going to primarily focus on this 11-year period, which is just coming out of the recession. And I want you to notice that Google still grew GAAP earnings or diluted earnings at a rate of 19.4%. But at this stage, historically, you actually see what appears to be a very high valuation relative to this orange valuation line. Now, when I put the normal PE on here, which is simply a calculation of how the market is normally valued this stock, we see that the normal PE for this stock based on GAAP earnings has been about 26, and with a blended normal PE of 31, that would indicate overvaluation. But as I mentioned, you can't judge a company just based on one metric. So next I'm going to take a look at operating cash flow and still focus primarily on historical results at this point. And when you look at operating cash flow, you see that operating cash flow has grown at 18.1% per annum, and therefore this orange operating cash flow valuation reference is a PE of 18.1, and then the normal priced operating cash flow is about 16. Now these are references. I want to make that clear. When I'm analyzing this, I can see that there was a time here when Google traded at a priced operating cash flow of below either the blue or the orange line, and some periods when they're above it. But what's most profound about this is you can see that the company's stock price has tracked operating cash flow pretty consistently over this historical time. So what does this mean to me? I'm really analyzing the data. That's why I call this a tool to think with. A normal valuation for Alphabet is a operating cash flow value of somewhere between 16 to 18. And that kind of gives me a fair valuation range. And so on that argument, or on that basis, with a priced operating cash flow of 17.4, Google looks reasonably attractive. Now, I do have some estimate data on this graph, some forecasts, which I'm going to get into a little bit more. But before I do, I want to take also a look at EBITDA. I talked quite a bit about EBITDA and operating cash flow and trying to determine which was the better valuation reference. And what's interesting here, if you look at Alphabet or Google over this time frame, the normal price to EBITDA, which is all I produce for EBITDA, has been about 17. The stock currently trades at a normal price to EBITDA of 16.5. So as you can see, EBITDA has been a pretty accurate or reliable valuation reference, or at EBITDA of, let's say, 15 to 18 has been a very reasonable valuation reference for Alphabet. And what's interesting is expectations are for EBITDA to continue growing by 17% a year going forward. So let's take a look at forecasting right now. At this point, Google looks attractive on an EBITDA basis. So let's go down to the EBITDA forecasting calculator here, and let's look at estimates. And there are somewhere between 19 and 23 analysts forecasting very strong EBITDA growth this year, which might partially explain some pretty good performance this year, followed by 17.3, and then the number of analysts drops off to 16.6, then followed by 18. So we've got this average estimated EBITDA growth of about 20.7%. And And this looks to be realistic, and it's pretty consistent with what Google has actually achieved historically. So in other words, analysts are expecting this to be more of the same. Now there is a cautionary element here that I'd like to point out. I'm going to go to the analyst scorecard and look at how accurate analysts have been when forecasting EBITDA. Now this is a 1-year forward forecast, and I want you to notice that they've been overestimating EBITDA growth on Google for the last looks like 5 years in a row. For the 2-year forecast, it's been a little better. They've only missed for the last couple of years, but this tells me something. When I look at this historically, analysts have been right about half the time, or the company has been right or beat estimates about half the time on a 1-year forward, and they've been right about 78 to 80% of the time on a 2-year forward. So, the reliability of these forecasts is something obviously you have to consider. Now, as I talked about, there's a lot of opinions on this stock, but I like facts over opinions. Now, another thing that I think is important here is I'm going to go back to operating cash flow for a moment, and let's look at forecasts of operating cash flow. As I mentioned, you got to look at numerous metrics when you're trying to make a valuation decision, especially on these high-profile growth stocks. Now, when I look at operating cash flow forecasts, I get an estimate of about 14.5% growth. If I go back up here and check the history, historical growth has been about 18%. So that's slightly lower than what historical record has suggested. Now, I do want to point out a couple of things. Obviously, Google doesn't pay a dividend. It's AA plus rated, has only 2% debt to capital. So it's an extremely high quality company, but it's purely a growth stock, and it's all about capital appreciation. Now, if I ran what-if calculations using this forecasting calculator, and the key thing is this is nothing but a calculator, and I assumed that this stock traded at let's say a 15 price to operating cash flow, which it has done in the past, then my rates of return would not be that attractive over the next year or so. It looks a little better if I go out to year-end 2019. But let's look at normal multiples for a moment. I've got this little drop down here, and you can see that Google has historically traded at a multiple, and more recently somewhere between 7.5 to 16. So I'm using the 16.3, which is actually the lowest historical multiple that the company's traded at. You could call that being conservative. And then if I run calculations on that basis, there is a double-digit rate of return potential for Google or Alphabet going forward on that basis. Now, if I look at longer-term trend line growth, and the key is here, this is a longer-term growth rate, the forecast is for about 19% growth, which is also relatively consistent. The numbers would look a lot better here. Now, what I like to do is I go into the custom calculator, and I bring in the near-term estimates, and then I don't apply the trend line until I've run out of near-term estimates. And once again, Google looks very attractive. Now, the real key is here, how good are these estimates? Now, when I look at the analyst scorecard on operating cash flow, I get an entirely different picture than I did with EBITDA. The analysts have been uncannily accurate on forecasting operating cash flow going forward. So perhaps I might have some additional confidence that these estimates might be within a reasonable range of error. And I've got my valuation corridor here, which is these 4 orange lines, the 2 orange lines below and the 2 orange lines above my normal priced operating cash flow. So anywhere in here I would consider a reasonable fair valuation, considering the fact that these numbers are probably going to be wrong. But based on all these various fundamental metrics, as I go through this process of analyzing Google, a couple of things that I think need to be summarized. Number one, there are 639, we'll call it $640 billion market cap company now, but they're obviously involved in an enormously growing enterprise, which we'll just call, for lack of a better word, the internet. But you've also got everything associated with that, the smartphones, the self-driving cars, artificial intelligence, all the things that I showcased when I shared the S&P Capital IQ long business description. So this is a powerful company. It's a growth stock. There are risks in that. Technology is obviously a risky enterprise, but this company has produced a tremendous record of growth. And let's look at performance for a moment. And I'm showcasing performance coming out of the Great Recession. I want to point out that Google was reasonably valued, trading at one of their lowest priced operating cash flows there, and it's moderately above their normal cash flow here. But if you look at this 18% growth over this time frame, Google would have averaged 23.1% annualized rate of return, which is remarkably significantly better than the S&P 500. And that's kind of important when you consider that this is one of the best performance periods that the S&P 500 has seen in quite some time. So to summarize this video on Google or Alphabet, if I judge this company or try to get a valuation reference based on operating earnings, I will get a picture that Alphabet is actually overvalued on that basis. If I make that same judgment based on GAAP earnings or diluted earnings, I would also come to the same conclusion that Alphabet is overvalued. However, when I look at operating cash flow, I get a picture that Alphabet is actually trading within alignment, and I think it's uncanny how clear this correlation has been. And likewise, when I look at EBITDA and value Alphabet based on EBITDA, I would also get the impression that the company is very attractively valued here. Not necessarily cheap, but certainly fairly valued. So when you're analyzing companies, especially high growth stocks, it pays to look at them from as many different fundamental aspects as you can, and at the end of the day, you have to apply your own judgment. This is a growth stock, and it's certainly not for everybody, but it's obviously a growth stock that's put together a pretty tremendous record. It's very dominant in its industry, and there's a lot of fine articles if you want to get more into what Google does and what their opportunities are. You can go into sites like Seeking Alpha or Morningstar if you're a subscriber, as I am, Bloomberg, and you'll find a lot of articles and a lot written about this powerful, very popular, dominant growth stock. It's been Chuck Carnevale saying thanks for watching.